This afternoon, it is my honor to introduce Fran Leahy, who will be the primary presenter today. Fran is a tax senior manager with KraftCPAs who manages our nonprofit tax practice. Fran has over 20 years of public accounting experience. Fran spends most of her time performing quality control reviews of our 990 tax returns Kraft prepares, speaking at organizational events, and assisting clients with tax planning and other tax research. Something personal I might mention about Fran is she really loves to spend as much time as possible hiking and camping in the woods. So I'm talking deep in the woods with, a 2-pound, 3-pound tent. She was actually showing me a new one she got today. That's about 3 pounds. So without further ado, I'll turn it over to Fran.
Thank you, Sean and Ken. We only have an hour, well, less than an hour now. And I know that you would like to get into the details on this. There has been so much that has happened. When we first signed up for, these seminars, we were going to do them in April, and we were starting to plan them in February. And if you remember February, you thought it was just another year, and it was just going to fly by, same as everything else. You would have the same challenges as always. Well, this year has been a little bit more of a challenge than anything else. And with tax laws, they have changed daily. So last night I was looking at some things, and actually one of our slides changed as of last night. So I will update you with the change as it goes. But this is going to be an overview. There is really no way we can get down into every little detail, but hopefully you'll have some, insight into a broader picture. And if you have questions, please let us know and we can help you out with that. Okay, so we're going to be taking a swing at first. The first thing that came out was the FFCRA, the Families First Coronavirus Response Act, and then that came along after that, it was the CARES Act. And then just recently, they revised that into the PPP Flexibility Act. I'm not quite sure what they're going to call that, the PPPFA, the PFA, I don't know. But, and then also in the CARES Act was the EIDL, the Employee Retention Tax Credit, the Deferred Employer Payroll Tax, and there's been a lot of other regulations that impact nonprofits. And also they had to throw us a little swing at the due dates. So the due dates, usually nonprofit tax returns, if you have a December year end, you are due May 15th. Well, actually tomorrow is your new deadline. And yes, we're doing this today. My hair's been on fire a little bit this week, but we're getting the returns out as we can. If you have not filed and it is your deadline, please make sure to get that extension filed, and your tax preparer will love you for that. Then we have the Taxpayers Certainty and Disaster Relief Act, and also Taxpayer First Act of 2019. Both of those happened before COVID. And then while we were in COVID, we had some interim guidance come out on silo rules. And then finally, I was going to talk about some red flags in our May presentation, but now we're just getting around to that. I put some slides on there. I'm not quite sure if we're going to be able to get those in. Okay, so let's just hop right into it. This was one of the first passages that was to help those that were quarantined and could not work or were sick, and they were caring for sick people. This was signed by Trump on March 18th. That seems so long ago. The main guidance on this is found in the IRS FAQs. So I do believe, and this is, lightning will not strike me, that the IRS FAQs are very good guidance. You will find there's, I think there's 94 of them at this point, but go to the IRS website, irs.gov, look at the FAQs. They will help you in finding out more details. There's a lot more examples. So this employer sick and family leave wage credit was workers are up to 80 hours of sick leave for their own health needs or to care for others, and up to an additional 10 weeks of paid family leave to care for a child whose school or care center is closed. The paid sick leave is for up to 2 weeks, up to 80 hours, which is up to $511 per day, and in the aggregate, $5,110. for 1 to 3 reasons. So there's 6 reasons in all. So the first 3 reasons you get paid up to $511 per day. The paid sick leave is up for 2 weeks at 2/3 of normal pay for the other 3 reasons. So you need to go and find out the reasons they're unable to work. So it's 2 different amounts, either $511 or $200 per day. And this also includes the employer's share of Medicare tax, the cost of maintaining health insurance coverage, and then you have an expanded FMLA. Okay, in any of these, we're going to be talking about several of these credits for payroll. In any of these, if your credit is more than the payroll tax you would normally pay, then you can get it back on a Form 7200. And you can file that Form 7200 before you need to file your 941. So you don't need to wait until your 941. You can say, hey, I want this money right now so that we can continue to pay these people. Let's go ahead and file this Form 7200. Then at the end of the quarter, when it's time to file your 941, you can balance it out. And so the details on that, there's been a whole lot. This is going to be the first quarter that it's going to really hit the 941s that are due as of July 31st. So there's going to be a lot of questions on that. But if you have more tax credit that you want right now, that 7,200 will get it there. Okay, the effective dates are all the way through 12/31/20. This one was actually effective the whole time. It's for 500 or fewer workers. The small employer exception is if you have less than 50 employees and it would jeopardize the viability of the business as a going concern, then you don't have to pay. Okay, the next thing is the SBA, the CARES Act. Okay, the Paycheck Protection Program, I'm sure a lot of you have heard about the PPP. The eligibility is nonprofits that are a 501c3 or a 501c19, and it also includes religious organizations, so a lot of churches have applied for this. However, it is not C4s or C6s, so we feel a little left out on some of our organizations. Some of our clients felt very much left out. Not more than 500 employees, but there's some exceptions. For example, if you have a restaurant with 1 location that's a smaller location, then you could apply for it. The application deadline, sorry, I don't have that, the deadline in there, was June 30, 2020. However, it's been extended to August 8th. So right now there's about $129 billion in PPP funding that remained as of June 30. So they wanted to extend that through August 8th. And that was just passed. I think the Senate passed it on June 30 exactly, and it was signed a few days later. So your calculation, I'm sure most of you have gone through this, is 2.5 times your average monthly payroll over the past year. And 10 million is the maximum amount on your PPP. What is that 2.5 times your payroll? Well, the payroll costs are your salaries, wages, commissions, tips, paid leave, healthcare payments, retirement benefit payments. However, excluded is any one person, individual that had an excess of $100,000 annual salary. That excess does not get counted. So just up to $100,000. Also, if you used any of your wages, your payroll, and you use that for your qualified sick leave that we just talked about under the FFCRA, then those have to be excluded from your payroll costs. And then any employees whose principal residence is outside the US. More information, you can't use payroll costs that are paid or reimbursed from another SBA, government, or other grant to calculate the PPP loan amount. Now, in June, I attended virtually, of course, I attended the AICPA not-for-profit conference, and they talked a lot about this. The regs definitely say that you cannot use federal grants, but it doesn't say anything about state grants. So if you have a state grants that pay your payroll, everyone is advising and saying that no, there is an assumption that the state is also under that umbrella. So if you have grants to pay payroll, you cannot use that for your PPP loan amounts. There's just, they call it double dipping. They don't want that. So even though the wording is not clear on state grants, it is clear on federal grants. Everybody that I've talked to says, don't try it. You might get burned on that. The loan may be forgiven if certain conditions are met, and we'll talk about those in just a minute. For the amount that's not forgiven, the loan is a maximum of, and it was 2 years at 1% interest rate, but the House passed, the House and Senate, and it was signed into law, the PPP Flexibility Act. That was passed on June 1st, which provides more flexibility, and that's the 5 years. So any of the newer loans now go under that 5-year amount, 5-year timeline. The PPP Forgiveness, originally it was an 8-week period. So as soon as you got your money, you had 8 weeks after the origination to figure out your expenses. Your expenses were payroll costs, including benefits. You had to have, you had to use at least 75% of your loan for payroll costs. And then the other 25% could be used as interest, rent, or utilities. This was the original, this was not the Flexibility Act. I like my little sign there, my flexible baseball people. This was signed into law on June 5th, and it made the significant changes. So the changes were, the loan can be used in a 24-week period after the origination on qualified expenses. Well, with the Flexibility Act, what are your qualifying expenses? Instead of 75% having to be used on payroll costs, it's 60% for full forgiveness. And then again, it's still the same categories for the other 40%, interest on mortgage obligations, rent, utilities, and it did extend the deadline to rehire workers to 12/31/20 instead of June 30th, because they wanted you to rehire your workers by June 30th for full forgiveness. Okay, so this is still, I know you're probably having a lot of questions, and I'm sure Ken's looking at those fielding questions, but let's get through the forgiveness bit and see if that, it's really hard to describe everything on those 2 slides. The covered period. Okay, a covered period is your 8-week period that begins on the PPP disbursement date. Now it's it could be a 24-week period. Okay, also if you have a biweekly or weekly payroll schedule, they're saying that you could figure out your 8-week period beginning on the first pay period following the disbursement date. So there was a little bit of flexibility. This was in the original PPP. There's a little bit of flexibility on when you start that 56-day or that 8-week period. The calculation now. The payments covered during the period, when we're talking about not the payroll, but the other payments, your mortgage interest payments, you have to have actually entered into that agreement to pay mortgage interest before February 15th. So if you're thinking, well, I'm going to be able to use this on a new place that I'm going to enter into a mortgage on, that won't work. It has to have been something that was already set up by February 15th of 2020. Again, the same thing with rent or lease payments for real or personal properties. The agreements had to have been in place by February 15th. And then utility payments. Utilities, again, on your building, that was set up before February 15th. So those amounts, depending upon whether you're using the 8-week or the 24-week, if it's the 8-week, that these have to be 25%, or they don't have to be, but that's the calculation, 25%. Or if it is the 24-week, then it can be up to 40% of your total amount of your loan. Okay, now a little bit of complex. So they said, besides using a certain percentage on payroll and a certain percentage on your rent and utilities, mortgage, etc. They also wanted to make sure that you're not reducing people's salaries. And so, and also that you have the same level of employees as you did before. And they're saying before everything was February 15th. That's their common number, date. So the PPP forgiveness for FTEs is a complex calculation that takes into account all the FTEs and a reduction, but it also has a safe harbor application. And so we're going to look at that in just a second. Okay, the FTE employee levels have to be restored no later than, and this was June 30, but the Flexibility Act changed that, but they have to be restored no later than 12/31/20 to the amount that it was prior to 2/15. So even the government thinks this is going to last a little bit longer. So, but they want the employee levels to be restored. Now, what if you can't do that? What if there's no way that you're going to get back to where you were at February 15th before? Is that going to make your forgiveness calculation not 100% forgiven? Let's look at that. We have two safe harbor rules, okay? The first one is sort of like a two-part thing. The first one is if you have the inability to rehire your employees. So basically, you're looking at your employees, you try to get them to come back, and they say no. And I've got an extra 2 in that. I'm not sure how on that. So it's 2020, say. So you want to be able to document. If you're trying to get your same employees back and you have offered them the job and they say, no, they're not coming back, you need to document that. Also, you have an inability to hire similarly qualified employees for those open positions. So say employee A says, no, I'm not going to come back. You need to document that. Then you offer a job to person B that applied, and they say they have the same qualifications, and they say, no, we're not going to work for you. We cannot, or whatever. Then you need to document that also. So this is a lot of documentation. Make sure you're getting things in paper. So that's your safe harbor. If you've tried that and you can't get people back in the door, then you're okay as long as you've documented it. You're still not going to have to worry about that reduction in FTEs. The second thing, the second safe harbor, is your inability to return to the same level of business activity as you were before, again, February 15th, because of compliance. The government doesn't want you having people in an office. They don't want more than 12 people, 15 people. You know, they don't want bars open. They don't want, you know, all the other things. They say, no, you cannot have that same level of people working for you. And it is a compliance. You need to document that. Make sure you are looking at what the rules are and printing them off. If it's a website or whatever, that website could change. Make sure you're documenting that you cannot return to that same level of FTEs. Okay, I'm going to pause here. We've gone through a lot in a really quick time and give you the first word. Okay, this is for your CPE credit. The first word is payroll. And I'm going to see if Ken, if there's any questions. Do we need to stop and?
Yeah, thank you, Fran. We did have one question that others in the group may be interested in if we have some 501c6 organizations, but there was a question as to whether or not there was any legislation in the works to include 501c6s in the Paycheck Protection Program, and we just don't know of any.
No.
There had been some talk and some push from different organizations, and you know, but I'm not sure that that's actually going to happen. So.
That's right now we don't have any knowledge that that's going to happen. So,
right.
But
back to you
can cross your fingers. Keep on crossing those fingers.
We'll certainly keep our eyes open for that issue.
Yes, and we'll let you know. Okay, so the first word is payroll. Okay, on your forgiveness. So there's been a lot of information really quick in this. How do you do your forgiveness? Well, there's a form 3508 and it has the calculator, it has how to do it, and it's posted on the SBA website. It's best just to start printing it off, looking at it, going through it. It's tough. Certification. Okay, if you have gotten a PPP loan and it was over $2 million, then they're probably going to be reviewed for certification of economic need. If you had a PPP loan that was less than $2 million, then you're deemed to have made the required certification in concerning that you needed the loan in good faith. A lot of people were saying, wait a minute, they're getting PPP loans and they didn't really need it. Okay, some more information. The amount that you receive on your PPP loan forgiveness is not taxable. It's like a grant, but there's a bad side to that too, of course, in that anything that you consider as being paid by the PPP that you're going to get forgiveness on, the payroll, any kind of benefits, your utilities, your mortgage, those are not deductible against income tax. So well, we're a nonprofit. It doesn't matter, right? It does matter if you have UBI. So it may impact UBI. And the caveat to that is that a lot of the UBI, you're not going to see revenues because people have been shut down. There's not as much UBI. So it's probably going to be a wash there. You'll have to look at each case to see, but you will not be able to use those expenses against UBI if you have that. Okay, so your strategy, are you going to do 8-week, 24-week, 50 days, 56-day period? Communicate. That's the biggest thing. Look at your audit firm, and also know that things could change. I think we're getting that. We do know that there's nothing as constant as change. And so there could be more information that comes out. There could be more guidance. And we do not have that crystal ball that will tell us this is the right time to apply. Is this 8-week right? Is the 24-week? There were people that applied for the PPP loan early and didn't get maybe as much as they could have if they had waited. We have so many unknowns out there, and we don't know if there's going to be more guidance that will be favorable or unfavorable toward you. It changes daily. So you just have to go with the information you know at the time and communicate. Okay, I do have one polling question because I wanted to find out what our audience has. If you received a PPP loan, what kind of period are you going to use for your forgiveness? And I guess I didn't give you the answer that could be, I have no idea. So, and Tara has put the polling question up. Give it about 10 more seconds.
Okay, I'm gonna take the polling question down.
Okay, if you could share the response, I want to find out what people are thinking. Okay, so we have a good part of 21% of our audience, 57% of our audience did not apply. So we might have some C6s out there. We might just have some people that didn't need it, and that's good. Thank you, Tara. Okay, another thing that's out there is the EIDL, Economic Injury Disaster Loan. This is also with the SBA. And who qualifies for that? The small businesses, and it's defined by various industries, and when to apply now through December 31st, 2020. So how much is the EIDL? It could be a maximum of $2 million, and it's basically a loan. It's up to 30 years, 3.75% interest rate for businesses, 2.75% interest rate for nonprofits. And the first payment is deferred for a year. The interest will accrue during that deferral. Now, there was a flood of applications that overwhelmed the system, and the SBA stopped processing after the first round of EDLs after about 2 weeks. And then the second round of funding, the money lasted about a week before all of a sudden the SBA limited the applications to agricultural businesses only. Then they were silent for a few weeks on the status of applications that were submitted, and they were supposed to have advances out there. Finally, they started showing up in the applicants' bank accounts. It's been about 6 weeks now. And so they're starting approving applications now. So the EDL has been through some issues. And last night, I just realized that as of Saturday, actually your advance grant option has closed. So when you applied for an EDL, you were applying for a loan, but you could just check this one little box that said, I want this advance payment, and it could be up to $10,000, and you would get it. It would just show up in your bank account. A lot of clients said that they weren't expecting it because they didn't realize that you could get it, even if you didn't get the loan, that you could get this advance payment. That advance payment has closed. They have exhausted the nearly $20 billion in emergency funding provided by Congress. And so now it is just a loan with those, that what we had talked about in the other, the slide previously on there. It's just the loans. And so there's no advance payments. You do have a lien on this one, and a personal guarantee may be required. And if you had the advanced payment, that is sort of into your PPP. So if you were applying for an EDL and a PPP, that reduced the amount of PPP, that advance payment. Oops, just a second. My little mouse got a little crazy there. There we go. Okay, part of the CARES Act is the employee. So I'm done with PPP, I'm done with the EDL. Now we've got the employee retention tax credit. This is another part of the CARES Act. And you can use this Form 7200 again, because this has to do with payroll. And the best guidance on this so far is from the IRS is on their FAQ pages. So you can get a refundable tax credit for up to 50% of the wages paid by eligible employers to certain employees during the COVID crisis. It's effective for wages paid from March 13th through 12/31/20. The eligible employees either are fully or partially suspended operation during any calendar quarter in 2020 due to orders from the government, or they're experiencing a greater than 50% reduction in quarterly receipts year over year. So if you look at the second quarter this year in 2020, and you compare it to the second quarter in 2019, and your quarterly receipts for that time frame is less than 50% less than last year, then you're eligible if you have suspended some kind of operation, and that's the result. The eligibility level is if you have 100 or fewer full-time employees in 2019, all wages are eligible, even if the employee is furloughed. If you have more than 100 employees in 2019, only the wages for employees who are furloughed or face reduced hours are eligible. Now, the caveat on this, because some of you are going, man, I need this. If you've applied for a PPP or an EDL, then you cannot take this credit. But if you have not applied, then this might be something for you. Now, the problem with this is, we'll talk about this in just a minute, about a timing on this. So it is your first $10,000 that is paid to an eligible employee. And so at 50% of wages, you would think it's $5,000 that you would get as a credit. The wages do not include WOTC eligible wages. They are included for payroll credits, required paid sick leave, required paid family leave, and FFCA. So none of those are included. So if you just try to think, if you've already used wages for something else, then you can't use it for this too. So if you're thinking it's too good to be true that you're getting double credits on something, it is. Okay, it doesn't work that way. Okay, this is a credit against the employment taxes. Now, on this, if you have an organization that is related to another organization and they're under common control, then you will need to aggregate those organizations to determine if they qualify. So you need to really look at if you are a standalone nonprofit or if you are related to others, and then you need to look at your control on this. Now on this, if you start opening up and you start having, your employees are back and you start having more income, if you again are comparing, say, the third quarter this year, 2020, compared to the third quarter 2019, and your gross receipts are 80% against last year, so you've had a 20% drop or better, then you can't take this anymore. So they're wanting this credit, the IRS wants this credit to be for those that are really hard hurt, 50% reduction, and you can keep on taking it until you get up to where you are at 80% of a prior year's gross receipts in measured by quarter. It's real confusing. I hope I've cleared this up. Another of the CARES Act specialties is the deferral of employer tax payments. This is the FICA match, the 6.2% of employer portion of Social Security can be deferred from now until 12/31/20. Now, when you have to pay that deferred amount is 50% has to be paid by December 31st, 2021, and 50% will need to be paid by December 31st, 2022. Now, when this first came out, they said you cannot use this if you had a loan forgiven by the PPP. And they said that as you could use this, you could defer employer tax payments all the way up until the point you got the note from the bank saying you had forgiveness. The Flexibility Act changed that and said, no, that's not right. You can use this no matter what. So even if you're getting forgiveness, you can still use this through 12/31/20 and defer that tax, and it's going to be deposited in 2021 and 2022, 50% each year. This is the same kind of thing. It's talking about estimates. Make sure you're making those payments. If you have a payroll processing company and you are still the one that has to make sure that you are making those payments. You are the sole responsibility. So make sure that you understand what is being deferred and when it is due. So by December 31st of this year, you make sure and have those liabilities set up to pay by December 31st, 21 and 22. Okay, the second of our keywords is credit. And this is for CPE credit, so the credit. Ken, do we have any other questions? I'm assuming not. Oh.
Hey, Fran.
Yes.
I actually do have one more that I'm not sure I fully know the answer to, although I know we've talked about this before. But if there were changes and somebody were to apply for a PPP loan and they have taken either the, the retention tax credits or an EIDL loan, how would you rectify that if you don't qualify for those other two programs? But then you subsequently apply for a PPP loan?
So you were taking the employee, not you, it wasn't the payroll tax credit, because you can take that in the PPP.
Okay.
If
So
it's,
the EIDL might be a good example. Would that just refinance into your PPP?
You can do the EIDL. It's just that it's going to add that if you got the advanced payment, it is going to add to the PPP. So you
Gotcha.
can
So
have
you
both.
could have an EIDL loan that pays other costs, can't pay payroll.
Right. You
And
can't
then you
double
have the
dip.
PPP.
Right.
Okay.
Right.
I think that is, yes.
And
Okay.
if you did get that advanced credit sort of moves over to the PPP. So it can, because it's a forgiveness issue.
Great.
And so you would
Okay.
try to use that for the things that the PPP would be used for.
All right. Thank you.
Mm-hmm. Okay. This is just a brief little bit about the Form 7200. So again, this is if you have a credit from any of those that we've talked about so far against payroll taxes, and it's going to be more than you're expecting to actually pay in payroll taxes, then you can file this Form 7200 and get your refund back quickly. So all of those credits are refundable credits. And you will have to reconcile this on your Form 941 at the end of each quarter. So for example, an eligible employer paid $10,000 in qualified leave wages, but their tax deposit was only $8,000. Then they could fill this out and get the extra, they could keep their $8,000 and then complete this and get the $2,000 extra back. And then they would just make sure at the end of their quarter that they're reconciling it on Form 941. Okay, so that's 40 minutes of the CARES Act. We still have a little bit more that's going to impact nonprofits. So the CARES Act also has a $300 individual above the line charitable deduction for 2020. And so we're hoping that that will spur a lot of contributions, that people will at least use all of that $300 charitable deduction for next year. Also, they modified limitations on the cash charitable contributions by individuals and corporations. So it's not subject to the 60% limit or the carryover rules for excess contributions. However, donor advised funds and supporting org contributions do not qualify. So don't think you're just going to be able to give a lot of money to your donor advised fund and it's going to be able to just build. They're wanting these payments to actually be going to a company right then. Your R&D requirements are going to be waived for 2020. So this is not good news because a lot of people that have R&D requirements that don't need that required minimum distribution from your IRAs, they will usually do a QCD. Now a QCD is a qualified charitable deduction distribution. And so what happens is if you had a required minimum, if somebody was over the age of 72 and they had a required minimum distribution of $20,000, they didn't need that, but they were required to take it. They could tell their IRA third party person to say, send it to a charity organization. It's a 501c3. And if it would go straight there, then they could, first of all, reduce their income because that required minimum distribution is then not taxable to them. It would also go straight to the charity and they wouldn't have to get an itemized deduction for that and thus maybe lose a portion of it in the calculation. So with that requirement being waived for 2020, there may be some people that are not actually giving through that means this next year. Not good news there. Okay, as I said at the beginning, we've got new filing and payment deadlines. So at the last minute, relief was granted on the 990 series through Rev Proc 2018-58 it it identified Form 990 as being part of the forms that would be now due on tomorrow, July 15th. So this also includes any payments. So if you have unrelated business income and you need to file a 990T, then you need to go ahead and look at that payment amount that should have been paid, plus any estimates for the first and the second of the estimates for the next year. And you need to look and see if you've got UBI for next year, if you're going to have it or not, a good indication of that. So hopefully you've been working on that with your tax advisor and you have made those payments. Also, if you have excess compensation, Form 4720 needs to be filed by tomorrow, or an extension and payment. Okay, this is a few things came out around all the COVID and the CARES and all of that. And so these have been pushed to the side a lot. This was the Taxpayers Certainty and Disaster Relief Act. And I'm trying to remember exactly when it was. Anyway, it was repealed it was the parking tax that we talked about last year, the Qualified Transportation Fringe Benefit. So basically, the IRS and Congress had decided that qualified transportation fringe benefits were included as an expense, was now taxable as income. And I'm not sure if they would have passed the same accounting classes as I took, because you're taking an expense and all of a sudden you're calling it income. So this original rule was applied, amounts paid or incurred after December 31st, 2017. So now it's been repealed retroactively. And so we must amend the Form 990T to receive refunds if the UBI was calculated and tax was paid. I'm glad to see that this was repealed, but it's made a lot of work because repeal, you pay the tax first and then you try to get it back in the amended returns. The Taxpayer First Act of 2019, this was a little bit before all of this again. This means that electronic filing the IRS is requiring electronic filing for all 990 series beginning after July 2nd, 2019, which the first year is the calendar year 2020, unless you have a fall beginning of the year, a fiscal year. There is a transition relief for small nonprofits beginning after 7/1/2021, and Form 990T is still paper filed. So they're going to require you to file your 990 series, but the 990T still has to be printed off and signed and sent in with a stamp. Supposedly, the IRS is assuming that this will reduce the number of incomplete returns because the software says, wait a minute, you check this box, but you don't have this schedule. You check this box, but you don't have this. And so it's hoping that people will file more complete returns. Also on your payment, you're going to have to use your EFTPS if you're not using it already. Enrollment does take a little while, and getting the PIN seems to be the hardest thing that the clients talk about, is just getting that in the mail, because it does come by the mail. Publication 4990 is a good reference guide for your EFTPS. And usually you have to submit it the day before. So if you've got a payment due tomorrow, you need to go ahead and try to get it in the works today. It's the day before, and then it'll still come out tomorrow. With that electronic filing requirement for the 990 series also, the IRS has different key points in there that they're going to be looking at. And so with them having electronic filing, it's going to be very interesting to see what kind of audits come out of this. Okay, I'm just sort of coming off of what I've been talking about, because to get to the next thing, I need to introduce it a little bit. So the next topic is talking about silo rules, and everybody's going, what are silo rules? Well, first of all, we need to talk about UBI. So for those that don't know, UBI is unrelated business income. I've probably made a couple of references to it already. Basically, you can think of it as a three-legged stool. So the first leg is that it is not substantially related to the mission of the organization. So it's income that doesn't have anything to do with the mission. Second, it's carried on like a trade or business. And the third leg is that it's regularly carried on. Okay, so if you have two of those three legs, your stool is still going to fall. Okay, so make sure you have all three legs, then it's UBI. Does it matter what you're spending the money on? No. It matters how you're getting the money. That's what the IRS says. So it must meet all three of those characteristics. Now, so the next thing is we've got some proposed silo rules. So first of all, let me give you a little bit of background. With the TCJA in 2017, they passed the rules that unlike for-profit organizations who get all these different revenue streams and they mash them all together and they come up with one number that's a net income or a net loss, they said, no, nonprofits, we're going to treat you differently, and you're going to have to separate all of your revenue streams, and those that have income will be taxed, and those that have losses have to carry those losses forward. And so we got some new proposed regs on those silo rules. And at first they said, for all those different revenue streams, how do you split them up? Let's look at the 6-digit NAICS number. That was our initial guidance. Now these proposed regs say that you can use the first 2 digits of the NAICS codes. And so instead of having a lot of different potential areas of income or silos, you're going to be able to combine a few things. So if you have UBI, start looking at it. Think about it. Do you have the different silos? Can you combine any of those? Look at the 20 NAICS codes and document. Make sure you have it in writing what you have determined it to be. Okay, so what changed? You're going to be able to combine the following. You can combine qualifying partnership interest, debt finance properties, and qualifying S corporation interest. Now, when I say qualifying, means basically the nonprofit does not significantly participate and is not a general partner. Now, there's a whole lot more detail on that, but basically you've got a de minimis test, a control test, and then a transition rule. And I have a whole lot of notes here that I could go into, but I might lose a couple of attendees on this. Anyway, basically you want to look at those you're just holding as investments. Maybe you get some K1s and you're not really participating and you have just a little tiny percentage. That's what can be combined. That's what a qualifying partnership interest or qualifying S corp interest in that. And then debt finance properties is when you have a debt finance rental. And so you can combine those. Basically, again, document. There are those 20 NAICS codes out there. And if you want to know what they are, shoot me an email. I'll shoot them back to you. Okay. The other thing that TCJA said on UBI was you have NOLs from your UBI silos. You cannot carry them back anymore. And when you carry them forward, they're only going to be limited to 80% of the taxable income. So you couldn't offset 100% of your taxable income from previous year's NOLs. Well, the CARES Act says that NOLs after 12/31/17 and before January 1/21 can be carried back 5 years and then forward with no limitations. So, I've got all these silos. Where did they say what I do with the silos? Yeah, they don't. So regs say that nonprofits should deduct the pre-2018 NOLs first from total unrelated business income in the manner that results in maximum utilization of the pre-2018 NOLs in a taxable year. Yeah, confused, right? basically we are looking for guidance from the IRS in the third or fourth quarter of 2020 to find out what to do, what can we do with these NOLs to get some money back. So if you had income in a previous year and you think you're going to have losses this year, keep your eyes peeled about NOLs and guidance from the IRS, because they say it's got to come out. We just cannot tell you what we can do with them right now. But it may be, we're hopeful that we're going to be able to carry them back. And we're hopeful that maybe we can get rid of some of the silos, but I just don't know. My crystal ball is a little foggy lately. Okay, that comes with our third word is silo. So this is for CPE credit. Our third word is silo. And Ken, do we have any questions on that last bit?
No, I think we're good, Fran.
Okay, we've got about 7 minutes here. A few other things have come out. So we got the final regs on Schedule B, and these are for organizations other than 501c3s and 527s. So if you're not one of those, then the names and addresses from Schedule B can be redacted on the filing copy with the IRS. So if you have a Schedule B, your 501c6, you have a Schedule B, you do not need to have the names on Schedule B on the copy that you file with the IRS. But you still have to file a Schedule B, and you still have to have the amounts on there, and you still have to compile that information and keep it in your work papers in case there's an examination. So you're still probably going to have to give your tax preparer all that information, and then the software is just going to take it out, and it's going to look more like a public disclosure copy of your 990. And then there's still some states that are requiring the reporting of this information, California and Montana. Now, Montana, this was originally sent out as a notice back in, it's been a while, a couple of years ago. And then the Montana governor decided, I think it's Stephen Bullock, and he decided that this was not right. And so he said that the IRS didn't follow their due process. And so the IRS turned around and then they followed their due process, and it still passed. And so it looks like there's still some cases out there that they're still trying to get information. They just don't think it's right that it should all have to be disclosed. Now we're getting into our red flags. So I've got the last 6 slides here are basically about things that you need to be aware of on your Form 990. And this comes with that electronic filing that is now required or will be required if you're a small nonprofit. And big nonprofits have been doing it for a while. But these are things that the IRS, we feel like, are looking for. They have about 250 little key indices. They wouldn't tell us what they were at the last nonprofit conference, but we've come up with some ideas of what they are. We meaning the industry. And so these are some of the things. Okay, so these are red flags that could cause questions or an audit or follow-up, any kind of follow-up correspondence with the IRS. Filing an amended return. Okay, it is recommended only to file an amended Form 990 in the most extreme circumstances. Now, we do know that we just talked about filing a Form 990T as an amended for the parking tax. The IRS is definitely looking for that, and that's no problem. But an actual Form 990, you want to try not to file the amended returns except if something is materially misstated and there's no way to explain it off the next year. Another item is you want to ensure that your W-3 and your Form 1096 totals agree with what is filed. When we do Form 990s, we always ask for copies of the W-3 and the 1096 because we want to make sure, well, whatever the client sent in to the IRS is what we're going to have on those numbers. We want to make sure because the IRS can look those up so easily. Fundraising expenses ratio. Fundraising expense over contributions revenue. Rule of thumb is 10 to 15%. So if you have some contributions revenue, you probably should have some amount of fundraising expense, whether it is a fundraiser or just one person that's been working on trying to send out donor acknowledgement letters and things like that. So you should have some kind of fundraising expense. A foreign bank account. If you have a bank account in a foreign country, you should be filing the FBAR. If you if it's a prohibited country, then you may need to file a Form 5713. So make sure you're filing everything that you need if you've got a foreign bank account. Look at your Schedule I reporting requirements. Okay, that is, Schedule I is the schedule for those organizations that you have paid grants to. So these are other 501c3 or other organizations. Make sure you get those federal ID numbers. So as you're going through the year, compile those ID numbers so you can get them onto the return really easily. Schedule F. If you are granting money to a U.S. organization that is going to turn around and send that money to a foreign organization, it should be reported on Schedule F, not on Schedule I. And make sure you're not duplicating. It shouldn't go on both. So it should go on one or the other. Another item is Form 990. Line 7H, vehicle donations received, but the nonprofit has not filed a 1098-C. You're legally required to file that. The number of board members doesn't agree with the number on Part 7. Make sure that you've got, it can agree, or you can figure it out, that you've got the date that people leave and you know exactly how many are still there. The 990 should be signed by an officer of the nonprofit. They don't need to be an officer during the time covered, but they do need to be listed on Part 7 as an officer. So if you've got a new officer signing, they need to be on Part 7 even if they weren't there during the year. Reporting rental income and expense on Part 8 and mortgages on Part 10, yet there's no UBI listed. You need to explain that. Non-cash contributions on Schedule M doesn't agree with the amount on Part 8, line 1G. If you have governmental grants of over $2 million and the single audit questions on Part 11 are not answered, because single audits are usually required on governmental grants over $750,000, so that would be a key indicator. And then finally, advertising revenue listed on Part 8, line 2 or line 11 without any UBI. Advertising is a big, that's a big red flag, just the word. And, whew, I'm done. It's 2 o'clock. Ken, are there any questions?
Thank you, Fran. We don't have any other questions that I'm seeing in the chat box.
Thank you all. Yeah. Thank you all. And if you have any questions that you think about later on your drive home or on your walk to get the mail or the paper or just outside to breathe some fresh air, just give us a call. You've got my number, and thank you very much for joining us.